All right. Thank you, everybody, for joining us today. This is being recorded, and I always say at the beginning of every single webinar, you guys, watch it again. Why? Because, for one, some of the nuances, especially if you're newer to options trading, might fly by you. The second time through, it's going to really ingrain it into your memory. If you watch it a month or two down the road, it's going to be like learning it over again. So I know you'll have some questions throughout. Also, please feel free to reach out at any time. I want to make sure everybody has clear concept before we start moving on to the rest of the webinar. All right. So this is going to be the short iron butterfly for our roadmap to trading options. What we're trying to do here with this specific option course is we're trying to lay it out like we've come up with our market assumption, a directional assumption, however that maturated, all right? And then we go through this process of finding the best strategy for any given assumption. So I don't like to just try and cherry pick where a butterfly is going to be, or just go out and buy long calls whenever it comes to mind. Like I saw somebody talking about buying long calls in a short duration contract, and it just blew my mind. It's like there's people out there on any given day that they come up with a bullish assumption or something like that, but they're just not setting these strategies up appropriately. And one of the benefits you guys have is from my 25 years of experience of getting stuffed with trades that I didn't necessarily want because I knew of all of the headwinds that would be involved in that strategy, being short duration, long calls and stuff like that. I had to very quickly learn to be mechanical, go out there and start hedging that position, because I knew that a long call, for instance, in a short duration just was not the best, was basically a recipe for disaster. So what we've done is come up with some guidelines for you guys to follow, or this roadmap for you guys to follow in order to find the right strategy. So yes, we are doing this on the short iron butterfly, and it feels like I'm kind of picking this out of a hat. But what we are going to do is find our way to the short iron butterfly, given our assumption we come up with around and underlying. All right. So without further ado, we all got that down. But let me get a couple of things out of the way for some of you who may or may not know me. I am Eric Wilkinson, and you might recognize me from mainstream media where they called me the Wolfman. I started trading in college with some money I'd earned, decided to move to Chicago with a finance degree, and jumped into the pits almost immediately thereafter. So in that entire time of my career trading, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, and just about all market conditions. All right, so I did mention we are doing this on the short iron butterfly, but we don't ever start out with a short iron butterfly in mind. Like, hey, you know what? I want to do an iron butterfly today. You know, let's find something that works with it. That may happen in some occasions where you're trying to create a strategy, or you're trying to do a delta adjustment, which I talk about a lot in the daily market commentaries with our portfolio, trying to adjust the deltas in that portfolio and finding the right strategies and stuff like that for that type of situation. But I want you to take this iron butterfly thought, and we're going to put it on a shelf for a little bit and go through a process of, we've come up with an assumption, like flipping through the charts on a particular underlying, and then we find the right strategy for that given assumption. All right. So in this webinar, what we're going to go over here, and I'm going to show you how to figure all of this stuff out as we go through, is we're going to figure out, you know, based on our directional assumption, which in this case is going to be a neutral type of directional assumption. So basically, we think the underlying is, you know, pretty much going to just trade sideways. So we've got a sideways directional assumption. Our destination, what we're going to be talking about here in the destination is that underlying a good underlying to trade options around, okay? So there's a lot of stocks out there that people have heard of and, you know, are household names, but they just don't have any participation in the options chain in order to really get involved in that. So, and I'll dig into the devil of the details there as we go along. The environment around the underlying is probably one of the most important things to take away from this. If there's nothing else to take away from this, is this environment thought. And that is really the volatility around this underlying that we're considering trading around. The underlying environment is really, really important. And really, we're going to be talking about volatility there. Not volume, but volatility. Destination is probably more volatility or volume than anything else. The duration. What is the best duration? This is days to expiration. What's the best expiration cycle for the this strategy we're going to be considering as we go along? And finally, strike locations. I'm going to basically hammer it out for you guys. Take that guesswork out of what strikes should I use. I mean, if you go online or you listen to people talk about these strategies, they might throw out some strikes for you for a given strategy, but they're not going to give you like a roadmap as to what you need to be looking at, what your risk reward for this specific strategy should be before entering that trade. All right. So I talk about this specifically, and I have some guidelines that we can follow in order to set up any given strategy. In this case, you know, take it off the shelf and the short iron butterfly. We're going to be talking about those strike locations. It's not just, all right, we're selling a couple at the monies and buying a couple out of the monies and then you're done. No, I'm going to give you guys some guidelines for that as well. All right, but so I see there's a lot of new faces out there. I want to just briefly go over, yes, the Greeks. And I know some people are like getting ready to click off right now, but I've got some easy ways to remember what these Greeks do for you and or against you. And one of the things is delta. Delta is the effects of the options premium based on what that underlying is doing. And all of these Greeks are with the assumption that we're moving forward or moving higher, okay? Moving higher in delta, meaning the underlying is moving higher. Theta, a day goes by, all right? Volatility goes up, okay? So all of those things are being consistent as to moving forward is the idea we really need to think about when we're looking at the option montage. All right, and I'll show you what the option montage is basically where the options chain is. All right, so if we're talking about this is assuming $1 move higher, all right, in the underlying, in XYZ, all right? In XYZ. So if we were to go over and click over to the option montage, we can see over here, let's just say it's XYZ. We don't really care what it is, right? What we're looking at is the options that are closest to expiration, all right? These are the monthlies that are going to have the most volume and open interest on it. And yes, you can probably click over here and look at volume and open interest to see if there's anything going on in this underlying on any given day, but that doesn't always give you the perfect snapshot at it. Plus, I'm trying to streamline your guys' process out there, right? I'm trying to get you guys to the end and implementing a strategy so we don't have to have all these clicks and backs and forths and trying to figure all this stuff out. I'm trying to make this simple for you. And when we're looking at this, for us, the underlying XYZ trading at 148.34 or 148.35 last. So we'll just say it moved up by $1. So 149. Let's just say it moved to 149.35. So we can all say that that's $1 move higher. So now we're trading at 149.35. That was $1 move higher. All of these over here in this delta column, we can see here the delta column all along here. There's different numbers there. So what it means is that let's just take this 150 strike, the just out of the monies. If the underlying moved higher for $1, then this 45 cents would then go into the premiums over here on the corresponding strike. Okay, so it would go from $3.60 to now we're at $4.05 on the bid, and on the offer we're going to increase by that same amount, so we're at $4.20. Okay, pretty simple. That's a $1 move higher. That's what we're all assuming here. But keep in mind, if it moves down by $1, that delta doesn't add into it. It actually comes out. Why? Well, you move down by 1, -1, plus a positive delta makes that a negative delta, right? So that's how the math is going to work there, and vice versa over on the put side. If we were looking over here on the put side, then a $- plus a positive, or a negative delta, I should say, $- plus a negative delta makes that a positive, right? So then that delta would add into the premiums on a downward move, all right? Currently, if we moved up by $1, then we would see 38 cents coming out of those premiums, right? Because it is negative. We can see it's negative. $1 move higher, which is the assumption, we would lose 38 cents. $1 down, negative plus a negative makes that a positive, so we would add in. All right, everybody pretty clear so far? I'm sure that one's pretty easy. Easiest way to remember is gamma. I mean, we don't talk about a lot about gamma, and most people don't. Maybe they'll be talking about a gamma trade or something like that, which I do talk about in some of my webinars. But at the end of the day, all we need to know is gamma goes with delta. All right, gamma goes with delta. We talked about this as being dollar number 1. Well, this is dollar number 2. All right, so on the second dollar, now we see gamma going with delta. And, you know, this is all other things being equal. We haven't seen volatility change or anything else, but it's just to get you guys to see the perspective here. And so now we would be talking about trading at 150.35, right? So now we've moved up by 2 whole dollars. This time the gamma goes with delta. So our premiums would then increase by 48 cents, right? So 48 cents on the second dollar goes in there. And so now we're talking about $4.53 on the bid. And then on the offer, we're talking about $4.68. Okay. So gamma goes with delta on the second dollar move. And on the flip side, if we had $2 moving higher over here, we've got a negative delta plus a positive gamma. Well, the second dollar, you would only lose 35 cents on dollar number 2, all right, on that second dollar, all right? So gamma goes with delta, and vice versa. If it went down by $2, right, on that second dollar move down, gamma would go with delta. We've got a negative plus a positive delta, which makes that positive, so we have 38 plus the 3. So we would talk about 41 cents, sorry, going into those same strikes on the second dollar move. Okay, gamma goes with delta. Theta. Theta is our thief. Theta is the thief in the night that comes and steals your premiums every single night. And one thing we notice about theta, it's the impact over time. So basically 1 day, right? We talked about moving forward. We can't go back in time. So theta is always going to be negative, no matter the calls or the puts, all right? It's a negative to our premiums. Every single day that goes by, theta, that thief, comes in and steals some change out of your pocket, all right? Now, theta isn't as aggressive way out in time as he is inside of this 36 days to expiration. As soon as you get inside of like 30, I like to say getting involved inside of 45 days, it starts really ramping up. Inside of 35 days to expiration, theta is really, he's coming into your pockets with both hands, it feels like sometimes. So theta ramps up all the way from 35 days to expiration to the last day of the expiration. He is, you know, trying to take every penny out of your pocket he can. All right. So in the beginning, it's kind of like he's nibbling away at you. Don't really notice it. Way out 100 days out, it's just like, you know, a couple pennies here and there. You don't really notice it. But inside of 36 days, you're going to notice those pennies are starting to rapidly come out. All right. So theta is always a negative to it. And it's basically as a day goes by, right? Half a day, you'd see half the day go by, you would see half of that theta coming out as well. If nothing else changed, you'd be able to see that a little bit easier. All right, and Vega. Vega is the volatility, all right? This is that one I was talking about. Vega is volatility. It is one of the most important Greeks to really understand, okay? Because it will positively and negatively affect your premiums, out of the blue, okay? Volatility, Vega is also a fear factor, all right? So, when things are going crazy, volatility starts ramping up, and when things are pretty calm and collective, they start coming out a little bit there. So volatility, understanding how it's affecting our premiums is paramount, and it is going to be the thing that we are looking at in order to determine any option strategy, okay? You have to understand where volatility is currently in relation to where it's been in the past, in order to discern what type of strategy we are going to implement. All right, so Vega, you can see, is over here in this column. It's over here as well. Now, this is the number we're talking about for Vega. So if it increased by 1 percentage point, right, exactly 1 percentage point, just like delta is $1, right? This is moving more, theta is 1 day. This is 1 percentage point, all right? So if it increased, I don't know why I put a $sign there. If it increased by 1 percentage point, then we would see all of these go into the corresponding premiums, okay? So down here, we would see these increase. It doesn't matter if the underlying is moving or not. If volatility increases, the Vega coefficient goes into those premiums. So in our puts, despite the fact that an underlying didn't move, we would see all of our premiums increase if the volatility started increasing. So, we could say we're at 318 now, just with 1 percentage point move and 328, right? 18 cents goes in there. Now, you guys might be saying, well, it isn't really that much if you look at it compared to what delta is. Well, yes and no. Now, we don't usually see underlyings move. For instance, with XYZ, it's a $140 stock, $10 or even $5 for that matter, right? A $5 day on a stock like this would be a pretty big move. Well, if we had 10 percentage points increase or decrease in this underlying volatility, which we can see happen on just about any given day, you can see that becomes a real thing to keep in mind, right? We got to really be diligent on watching where our volatility is and what it's doing to our premiums. Same goes over here. These would add in to our premiums on an increase. Now, obviously, volatility goes down. What happens? Well, a negative plus a positive makes those volatility or the Vega coefficient become negative across the board, all right? So they would all our premiums would start decreasing by that corresponding amount. And I'm going to drill into these. I'm not just touching on it and expecting you guys to remember this. When we talk about these strategies, we're going to really dig into these details. All right. So one of the things we're doing is we're flipping through our option or our charts or watching TV, and somebody says something, maybe it's on Twitter or whatever, and it sparks an idea. You get the light bulb to go off, and you say, you know what? I'm going to take a look at this specific underlying, and because we're heading into earnings season, it left my pickings a little bit slow or a little bit narrower. Next couple of weeks are going to be really heavy into earnings. So I tried to pick something that does not have an earnings. Well, XLK, which is the ETF for the technology sector. And if you guys watch my daily market commentaries, you know that this is one of my theories with the tech sector right now, is that I think that they're going to calm down a little bit. And it started showing up a little bit today where, yeah, they were down today, but, the Dow Jones and the E-mini S&Ps weren't suffering quite as much. So I think that we're going to see some volatility in these tech sector, but I also think they're going to kind of meld out and be a little bit flat here. So ultimately what I'm thinking here is, where are we going is XRT. So basically I want to go to XR, or sorry, why do I keep doing that? I do, for some reason, XLK, XRT, for some reason, I have stuck in my head when I think of XLK. And I don't know why. But at the end of the day, let's just say instead of Salt Lake City, we're talking about XLK. All right. So, you know, we're taking a look at XLK for our road trip for spring break. And that's kind of like where our thought process is. I'm looking at this underlying in XLK, and I obviously, you know, I'm not bullish in XLK, so that's out. I'm not really bearish. I'm pretty market neutral. So what do? Starting to narrow down our strategies that we're going to really implement around this XLK idea. But I think that XLK, you know, we might see some movement here, but for the most part, I think it's going to stay within a pretty tight range. We might pierce it a little bit to the upside and downside, but ultimately, I think that, you know, we're starting from here, and we're going to head out to XLK. All right, so XLK is here. So I've got pretty flat line that I'm going to get to my destination on this roadmap to get to XLK from my starting point. Now, the next thing, this is the destination idea. So is XLK, is this a good destination? Now, some of you guys might be saying no, so, like I've never been to Salt Lake City. I've got no desire to go there. Well, I'm biased. I'm a skier, actually a snowboarder these days. If you ever are a skier or a snowboarder and you haven't been to Salt Lake City or XLK, you need to go. It crushes Colorado. Anyway, that's my idea. But so is there a lot of things going on in XLK? Well, within 45 minutes of Salt Lake City, there's like 8 ski resorts that you can go to, and you can stay in Salt Lake City pretty cheap and travel to all these different ski resorts within 45 minutes. You can't do that in Denver. So at this juncture, you know, yes, I'm thinking I need to look into XLK and see if there's a lot of things going on. So we've got XLK up here. So what I have for a rule on this is our guidelines to finding out if this is a good destination. We need to move the decimal 3 ticks to the left. All right, we do that and we have 12, right? So 12 cents, right? We've got 12 cents if I move that decimal 3 ticks to the left. What I need to know is if this is a good destination is to look down here at the option montage with the 35 days to expiration right around there. We're closest to that. That's usually what we've referred to on the floor as the spot month. Why is that the spot month? Because that's where all the eyeballs are, right? And one of the better ways to see free market price discovery going on is to be participating in the one that has all of the eyeballs. So this is a good judge. This 35 days to expiration is a good barometer, if you will, as to whether or not there's going to be a lot of open interest or eyeballs on this underlying, all right? And it will filter out to the further duration ones that don't necessarily fit this rule. So we're following this rule inside of the 35 days to expiration, whether or not we would be using this specific expiration cycle to implement any given strategy. We look for this rule in and around this particular one. So 12 cents. So we look at the bid offer on these and try to make sure that for the most part, they are within that rule. Yeah, we got a couple that are slightly outside of that by a couple of pennies. But for the most part, you can see that there is a good representation of that 12 cents to the bid offer, all right? So for me, what we're looking at on this particular one is that would be, in my eyes, considered a green light, all right? So when we're looking at this, I like using this one just because it allows me to quickly move back and forth to different colors. So if we're going along with our roadmap mantra, all right, so we've got our stoplight, right? Well, if it's 12 if it fits the rule, All right, if it fits the rule, then that's a green light. All right. If it fits the rule, then it's a green light. If it's 2 times the rule, then we've got a yellow light. All right. And if it's 3 times the rule, then I would say, especially if you're a newer trader, that's more of a red light. I wouldn't want to trade options around, an underlying that's trading around $120, and the bid to the offer is like 30, what is that, 36 cents or something, 36 cents, yeah. That's just really wide. And what that means is there's not a whole lot of participation in there. There's not a whole lot of eyeballs in there. So I'm going to have to give up probably 20 cents from the offer to make that really tight, because that guy on the bottom, that guy in the bid is probably not going to come and meet me in the middle anytime soon. All right. He might give up a couple of pennies, but for the most part, he knows he's the only one making a market. So it's going to be harder to get a transaction going. If it fits the rule up here, I should make that green. If it fits the rule up here, what the thing is people are falling over each other to try and get on the market. Something like in XLK, if I put in a 490 offer on these puts, if I've tried to offer it at 490, somebody's probably going to bid 485. They're like, hey, I'm ready to do some business here, all right? So you're going to see a lot more free market price discovery. You can also correlate it to, like, you go to a farmer's market, there's one guy selling apples, he's not going to be budging off of his price of those apples, right? Whereas if there's 10 different setups where they're all selling apples and the same apples, well, they have a little bit more wiggle room on what they're charging for their apples, all right? So that's the kind of situation we want to get involved in. And we can see several examples of this where we move on to, say, something like Intel, which is less than $100 stock. So if it is a stock that is, if it's less than $100 stock, then my green light's saying it's less than or equal to 10 cents wide. Again, 2 times the rule, right, is a yellow light, and 3 times the rule is a red light, okay, on that stop light idea, okay? So any stock that's less than $100, we really want those bid offers down here in the option montage to be less than or equal to 10 cents wide. You guys might be saying, well, okay, that sounds all hunky-dory. You're not really using high-priced ones. I took a snapshot of Amazon today during the trading, right? Again, we moved the decimal 3 ticks to the left. What do we have? $3.30, right? Well, look down here at the option montage to the bid offer. You can see it's fitting that rule. So when you're looking at Amazon and saying, oh my God, that bid offer is really wide, well, in relation to how big this underlying is trading, it's not. These are actually really tight markets, all right? So you can see that works out on the bid offer here across the board for the most part, all right? So that's our rule of thumb for that. And 2 times the rule, it starts getting to be a little bit of yellow light. Throughout this process, you get too many yellow lights. No, you're getting into a bit of a high risk category there, all right? I like to say basically if you get a red light, there's other things that you could be doing that would be more beneficial or higher probability, okay? All right, so what's the environment? Now, this is where I told you guys this is key to our success, right? Well, we can think about it if we're doing the whole methodology of having a roadmap. Low volatility, you can consider that like it's sunny skies, right? There's no stress level when you're out driving when there's sunny skies. But then when it gets to be a little bit crazy or there's storms, there's thunder, lightning, visibility is low, well, you're stressed out. You're doing a little bit more white knuckling as you're driving along, right? So how do we determine when we're doing options if it's raining outside or there's high volatility? Well, you might be saying, well, when the VIX spikes. Well, yes and no. The VIX is a good gauge of overall volatility in the markets, but I want to know specifically what is happening to my underlying. All right. I don't care about the rest of the world. I want to know what's happening right here, right now in this specific underlying. Okay. Thank you for that. I want to know what's happening for my underlying. So what I need to do, remember that Vega coefficient, that's going to be top of mind. That Vega coefficient, it was 23 for our XLK, right? That doesn't tell me anything. It doesn't tell me if it's sunny skies or it's high or low, right? So what we need to do is for some of you guys that like to really drill down on the minutia, all right? Here's what we're going to be looking at is you take where that current IV is, and I've got a streamlined process for you guys that I'll talk about here in a minute, but this is for people that really like to dig into it. Current minus the low, IV, all right? So this is implied IV is implied volatility. That's really what Vega is implied volatility. All right, it's not just volatility, it's actually implied volatility. All right, so, and I don't look at historical volatility, I look at implied volatility, all right? So the high minus the low, IV, all right? So literally what we're doing here is if you're looking at a chart, and this is what I look at, like you got an IV chart, all right, and it kind of goes like this. All right, that's usually what an IV chart is. And this is current. This little dot right there is current. And what we're trying to do is find out where current IV is in relation to the high and the low. All right, so I want to figure out where it currently is. Is it near the high end of the range or the low end of the range? That's literally what we're trying to figure out. It's pretty simple that way. If you like to dig into the devil of the details, then figure it out to the minutia. I have actually script for at least think or swim toss that you can throw over there in the watch list. I rate everything. I put everything in a category where it's highest IV percent to lowest IV percent. So this equals IV percent. Basically saying where the current is in relation to the high and the low, all right? And why does implied volatility matter? Well, because when volatility goes up, what happens? Those premiums go up. That's why volatility is important to understand, is because we need to know when we are trading or dealing with options, are those options premiums? Are they expensive or are they cheap, right? I don't know by just looking at the option montage over there on the side. I mean, 23 doesn't mean anything. 23 could be incredibly high for this underlying, or it could be incredibly low. You know, like Tesla will never get to a 23 implied volatility. It just doesn't. Like a low for Tesla is like somewhere between 40 and 50 maybe. All right, so we need to know what that implied volatility number is in relation, because if volatility goes up, our premiums go up. If volatility goes down, remember, then those premiums go down, right? So we need to know why, because volatility, if we already cleared this up, volatility affects the price of an option in relation to those percentage points. So when volatility, and we're talking implied volatility, IV is high, we need to sell premium, right? You want to sell something when it's expensive and buy it when it's cheap. So what implied volatility tells us in that whole, ratio that mathematical equation I told you, it tells us if it's at the high end, we sell premium. If it was 100%, that's at the high end. And if it's at 0, it's at the low end. Now, keep in mind, one of the problems with this equation is that, it can continue to go higher and that's still 100%, right? We can't always nail the high and nail the low, all right? We can't do that. Just like with a stock. Whoever out there has ever bought the low or sold the high, the low tick or the high tick, right? On the floor, we were able to do that a lot because, you know, we were getting hit with trades all the time. But in this mark on the screen, I can't tell you that I've ever sold the high or bought the low. I bought very close to the low, but it wasn't the low tick. All right. So what we're trying to do is capture where that is. So we talked about this. I'm looking at XLK as my trade, right? So here is, I have a chart of it, implied volatility down here, right? And what we're looking at for XLK is 33. All right, so I need to know where 33 is in relation to the high and the low. That's going to be key to this. And one other thing that's key to this is on a stock, I say high IV is greater than 50% when we do this equation thing for a stock, and low is less. Low IV is less than 50%. Okay. All right. So that's somebody like me. I have a relatively high risk tolerance. I have no problem if you guys make this your rule and say the high IV and low IV, right, say is greater than 75%. You could do that and say less than 25% when you're getting involved brand new to options, okay? This will limit your opportunities, okay, and limit when you can do many trades, okay? But it will also, you know, get you where you're at the high end of it. Now, one thing I also want to note is I've been talking, and I think that we are kind of out of the woods of that extremely blown out implied volatility. Yes, I do think for the rest of probably 2020, we're going to continue to see high implied volatility, or higher than what we were seeing in 2019 for sure. So for the rest of this year, I think we're going to see relatively elevated, like the VIX 20 is the new teens, right? So I do think that we're going to see that. So I don't think that high implied volatility is going back to normal. But, you know, this type of mark, the last time we saw this was like in 1984, or then before that was 1929. All right. So those are the last two times we saw those volatility spikes, even more so than back in the financial crisis. We didn't see this kind of volatility spike. So, you know, it's a black swan event in my eyes. All right. So that's the way I'm playing. You don't have to do that. You don't have to follow my guidelines on that. You could say, you know what, Wolfman, I think you're crazy. I think we could easily see those spikes on the highs and those you know, lows. So I want to be safe and put this into perspective. Now we are looking at an ETF, and an ETF has a basket of goods in there. So the volatilities of all those underlyings are going to kind of meld together, and they're going to narrow each other out. So for an ETF, I say, you know, greater than, or sorry, less than 30 IV% is a buy. All right. And then greater than 30% is a sell. And again, I don't care if you adjust this. Maybe you say, maybe it's 15 and 65 or something like that. Maybe you could say less than 15%, or, and I hope I'm not going off your guys' screen, or what did I say? Greater than 65, something like that. Probably 50 or something. All right. Because relatively, it's not going to get that high. So if we looked at this particular one, and I took this high mark there, drew a line all the way over here, basically that comes out to, I'm going to say 78. All right. This low mark, I'm going to draw it all the way across, and I'm going to say that that is around 12. Okay. So we've got our high, we've got our medium, or our current, and we've got our low. So basically what we're going to be looking at is that same thing. We got the current minus the low, right? So the current is current IV minus the low IV, right? This is for people that like to really drill down on it. So the current is 33 minus the low, which is 12. We divide that sum by the high, IV, minus the low, IV. Right? Okay, and then so we had 78 minus the low, which is 12. So we've got basically, what is that, 21 divided by 66, right? 21 divided by 66, is that right? Let's make it do so about 31.8%. Now that's what Toss is going to throw over there. I said I want to kind of discount this part up here, all right? So in mine, what I would be looking at is saying that this high is probably, representative of what we're looking at. So I'm going to say that's 45. And then the low is going to be a little, because I don't think that we're going to be down here either for the rest of this year. So I'm going to draw a line there and say that that is my current low. So that current low, let's just say, is now 26. All right. So in this case, then we're going to go 33 minus 26, divide that sum by the high, which is 45, minus the low, which is 26, right? So now we're looking at 7 divided by 19, right? 7 divided by 19 on that kind of puts that around 36, 37, I'm going to call it. All right. So for me, I'm just going to call it 37. Even the 31, if I take everything else in, it fits my rule for being greater than 30%. All right. So we're greater than 30%. To me, what does that say? I've got high implied volatility for this underlying, high implied volatility percent. So that, according to my rules, is high volatility. All right. So if I have high volatility, what do I want to do? I want to sell something, right? So I've already come up with my assumption here. My assumption is I think it's market neutral in XLK. I think the destination is pretty good. Now I know I have high volatility. What do we do when we have high volatility? We sell premiums when they're expensive. Now, if you think volatility is going to continue to go higher, then obviously that would not necessarily be the case, right? This is the expectation. My expectation is when volatility is high, it's going to revert back to the mean or revert back to the middle, 50, all right? When it's low, it's going to revert back to the mean or the middle, which is 50. So for me, with ETFs, it is usually right around 30. So I would expect we're heading into an earnings season. I mentioned that already. So there's high volatility in all of these tech stocks right now. So as that volatility comes out, I can expect that my overall implied volatility for XRT will come out as well. All right. So I've got high volatility. I'm leaning towards selling, right? I believe volatility is coming out. I think that the idea is I'm going to be selling premium. So I'm already taking away probably 75% of all of the option strategies out there, right? Because I don't have a bullish assumption. I don't have a bearish assumption. That took those out. I have a neutral assumption. I think I'm going to be selling premium. So that narrows it down even further, right? We're getting closer and closer to where our end game is. But one of the things we also want to figure out is if we have high volatility and I'm selling premium because I want to sell high premium, want that premium to go down, what do you think our duration is in that option montage based on our Greeks, right? Remember the Greeks? What did I say about that? The thief in the night. Duration is the thief. Well, if we have a thief and we're selling premium, we want that thief on our side, right? So I'm selling premium. I want the thief on my side. I want the duration to be relatively quick because when we're selling an option, we want to exploit that theta. We want that thief to be in our back pocket. And here's another representation of what I was talking about. So that 35 days to expiration is the wheelhouse. Why? Because look at what happens to our options premium. You know, I mentioned I like to go as close to 35 days to expiration as I can. So, you know, 45 days, you know, is also definitely in that wheelhouse. But you can see that inside of 35, it really starts rapidly decaying. So if I'm selling premium, I want that thief to be in my back pocket. So I want to be around 35 days to expiration is my key. Okay. When I'm selling, when you're selling options, right? Out here, this is the buy zone, right? You're buying options. This is a buy zone, right? Because the thief isn't very aggressive. I want to turn the tables in my favor, right? I want to try and increase my probabilities of success. And that's how we do it, right? We note where our options premium is because that's key. You know, just like I talked about this guy going out there and buying the weekly November contract expiring on the 6th, buying calls in an underline. Why are you inside of November 6th? I don't even know how many days fighting that uphill battle. I mean, your premiums, you bought it, and that's what's going to happen to your premiums. You know, obviously not setting it up correctly in my eyes. All right. So what vehicle do we use? I've got a neutral strategy. I want to sell premium. Well, neutral strategy means that you know, you're going to try, and you're selling premiums. It means you're going to try to figure out where we're going to be stuck in this range, right? So if we're stuck in a range, we're leaning towards like the iron butterfly or the iron condor and stuff like that. Well, the difference between the iron condor and the iron butterfly is going to be your risk reward tolerance, for one, but two, there's a higher reward for this, but you know, it takes a lot longer to mature, to a lot longer to get to your to get profitable with the iron butterfly. Why? Because those at the monies, you know, they have a lot of gamma, a lot of delta. They're fluctuating quite a bit. They're being affected by all of the Greeks more so than just about anything else. So yes, you can make a lot of money on this. So the idea between the iron butterfly and the iron condor, which we'll be doing in a week or so, the idea here is I'm a little bit more sure that this range is going to be a little bit tighter. Whereas if I thought the range might be doing something like that, you know, that might be where you're leaning towards the iron condor, and this is the iron butterfly kind of idea. All right. So I think that there's a little bit tighter range, and, you know, I'm a little bit more worried about that range bound. Okay. Does that make sense so far? All right. So what vehicle are we going to use? For me, I'm pretty sure we're going to be trading at a pretty tight range. So the short iron butterfly is my go-to. So what spots are we going to visit along our road trip on the trip to XLK, greatest snow on earth? You can tell where my mind is. Well, the short iron butterfly, it's pretty easy because, you know, the straddle, when you're looking at, that's a symbol for the straddle, by the way, at least from a floor trader perspective, is we're selling the at the money calls around the 50 delta. That's the ballpark that we're going to be looking at. But most people out there, you know, then they just go out there and they define this risk by buying a call and a put just to define that risk, or they just look at the drop down menu for an iron condor or an iron butterfly, and they give the predetermined strikes. Well, for me, that doesn't make sense, because to me, I think you need some risk reward strikes in there. So my rule for this is basically, you know, you look at the straddle, all right? You look at the straddle and you're going to collect the credit, right? So you're going to collect the credit. So my rule on this strike here, or this strike here, is basically you look at 2 times the credit. All right. So if it's $1 credit, well, then you're looking at going out $2 on that option montage. You know, $20 credit, you're looking at moving your wings $40 wide, which just so happens to end up being right around that 10 delta. All right. So I've got a couple of things for you guys to look at here. We look at, for me, to find that strike location, I usually just do the straddle, and then I just do 2 times that straddle. I know I got to move that far away, all right? But I will tell you that it's going to come very close to that 10 delta. So if you like to just look at the delta and don't like to do the math or double it up there, then that's what we're looking at, all right? So, and my rule for this is I like to collect your credit is 50% the width. All right. So, you know, if I had $40 wide between these two, these were $40 wide, right? Between the short strike and the long strike, then I would need to collect at least $20. All right. And if it is, so for that, you know, that's our green light. So if you collect greater than, I'm going to say greater than 50% the width, that is your green light, right? And if it's less than, let's say 40%, you know, that's kind of your yellow light. And anything, you know, somewhere between, I should say 40 and 50% is your yellow light between these two. Less than or equal to, if it's less than, actually, if it's less than 40%, that's kind of where I'm starting to think a yellow, red light. But somewhere in between 40 and 50%, that would be your yellow light. Sticking with that theory there. All right, so I've got it set up here for XLK for us already. And you can see I went with the 122s. So I'm going to pull this up on my platform. I did this because you can see I got a little bit greater than 50% there. I don't know if it'll work out after the close, because sometimes what happens there is that the markets get really wide. So we might see that happen here. Let's pull this over and get into the real platform. I'm just going to punch it in here. XLK. Let's just look at this. I don't need any of these other ones. Here's also what I was talking about when you're looking at the option montage. Thinkorswim, we'll throw it down here, 31%. I have this script that you can throw over here into the side to figure it out, and you can see I have it listed from high to low. You know, I could look at Amazon. I did point that one out in the earlier on, but they have an earnings right here. So I want to stay away from earnings for this. I have strategies for earnings that I would use for that rather than setting this up right now. So back to XLK, 36 days to expiration, right? Because I've already determined this 33 is in the upper band, so I know I'm selling premium. So let's go to the at the monies. It's a pick 'em between these two. So for me, I'm going to look at the deltas. That's another thing we really like to do, is have this built out to be delta neutral, right? Because if I sell an option, right, I'm selling this call. Well, another thing to think about is if I'm selling this call, a negative plus a positive is making that a negative, right? So that's negative 50 deltas, right? Well, if I flip over to here, sell premium, I'm selling a put, a negative plus a negative is a positive, so that's a positive. So you got negative 50 delta, positive 50 delta, those equal each other out. Or negative positive 50, negative 50, you know your flat deltas there. All right, so I know I'm delta neutral right now, so I need a lot more. I'm just going to go to all. Just make it, I thought I'd make it easier on myself. All right, so here we go. We're starting out with $9.50, right? So let's call it $10. So what was my thing to go? We either look at the 10 delta or 2 times the delta or 2 times the credit. So in this case, I'm going to be looking at $10 higher, which would put me at the 32s. This is probably why I went a little bit wider on the other ones. And it's kind of a ballpark. You can see that's only a 19 delta. $10 lower, $10 lower is 12. Okay. So that fits that rule a little bit better. So we could do that one. $6.73. It's I only went. Wait, what was my? I did that wrong. Sorry, guys. So sold this one, sold that one. $10, so I got to go $20 wide, not $10 wide. Nobody jumped on me on that. Come on, guys, you got to wake out there. So $20. I need to move up $20. All right, so I'm moving up $20 to the 42s. All right, and then I'm going to move down $20 to the 02s. Buy that one to define the risk. Make sure I set that up correctly. Yes. So it's $20 wide, and which is where we're starting at, right? And you can see $8.50 or $8.70 is not in line with that. Sometimes when you get extremely high volatility, you will see that work out quite nicely. As a matter of fact, I could do it on an Amazon trade, and we would see that work out perfectly. But with this, it's not. So I'm going to go back and I'm going to change these strike locations and check out the 10 delta ones. So I sold the at the monies. The 10 delta here, I'm just going to go up to 36 on this one to buy that. But too many legs. Sell that. Hold that. The other thing, when I'm building this out, I build out all my strategies. I hold down the control button to click on these. So when I'm clicking on them, I'm hitting the control button. So going to the 36 then, which is that 10 delta. So I've got basically 14 to the upside. So I want to look at 14 to the downside, right? Which is going to put me at the 108 to make it equal distance. All right, so I've got $14 wide on these, and I've got a little bit better than $7. So that makes that a green light. So that works out quite nicely. To me, that'd be the wheelhouse. Yes, there's skew to the put side on here. I'm not worried about that. I'm trying to make my things a bit more equal distance. I'm not breaking the wing on this or any of those things, all right? So I'm making it equal distant iron butterfly for this particular one, all right? So we can see that all of that stuff worked out quite nicely. It was a little bit better when I did it earlier today, you can see. So that's the process we're going to kind of look at when we go through this. 2 times that's the starting point. That's usually, that's about as wide as you can get. And if you can get 50% of that, that is like a screaming good deal. All right. But ultimately, we want to build it out to where we get at least 50% the width of the stripes, okay? That means your reward is better than what your risk is on that trade, right? All right, so you guys got this. We talked about this. Direction. We need to come up with our direction before we come up with any strategy, right? So we determine our direction. Our destination is that rule where we move the decimal 3 ticks there, or if it's greater than $100, XYZ is greater than $100, then it's move the decimal 3 ticks to the left, and it's got to be equal to or less than that. If it's less than $100 stock, then it needs to be less than or equal to 10 cents wide. Environment. Our environment is implied volatility, right? We have high IV. We already determined that by that mathematical equation. Our duration, that's where we want the thief. Our duration is, around 35 days to expiration for this strategy. And our strikes, basically we want to take the credit times 2. All right, credit times 2 equals our width. All right, or 10 delta to define it, or the 10 delta to define. All right. I don't know why I went back. All right, so let's talk about the max profit, and I'm going to pull this. I got a couple other things real quick. Max profit is the credit received. All right, max loss we've got to worry about. Our max loss is basically the long call minus the short call minus the premium. All right, basically it's the difference between these two minus the premium. All right, that's then our max loss. All right, our max credit is, our credit is the max profit we can get. The max loss is whatever's left between those strikes that we were referring to. And the put is the width of the put spread minus the premium. All right, and then whatever's left is our max loss. Our break even is going to be the short call plus that credit received, because our break even increases by that credit received. So a short call, which is that at the money, and in our case we were collecting $7 and some odd cents. So my 122 strike plus the $7 to the upside is my break even, and the 122 strike on the puts minus that credit is my break even to the downside. Anything past that, that's where we would start to lose money till it was defined. All right, so we already talked about this. It's XLK, all right, and we're taking the iron butterfly. All right, for a winner, I'm getting out at around, I usually like to get out of this one at around 30% of max profit, all right? Right, on the loss, what do we do on the loss here? Now you can look at it when it hits your break even, you're getting out. I usually like to ride these strategies out a little bit longer than that and become a little bit more mechanical if it's not working out. The beauty in the iron condor and the iron butterfly for that matter is these are very flexible. We can play around with this. And I actually have a whole webinar on the mechanical adjustments on this. For instance, if our break even is being breached to the downside, the market goes down and starts hitting my break even, you can become mechanical and start moving the short call. If the market went down and started testing my put side break even, you can move those short calls, you can start adjusting the calls to increase your success on that, all right? You can start moving the short calls, I should say, and get a little bit inverted, try and collect a little bit more credit, which increases our chances there. So we start adjusting those positions a little bit. I don't have time to go into that. That's a whole webinar on adjustments on the iron butterfly, so please check that one out too. But on a loss, you know, also say that if your credit increased by 50%, you would be out, all right? I'm looking at a 30% of max profit. You could say, though, if you have a lower risk tolerance, that if it increased by 50%, you're out. Write all these things down so you guys stick to your guns, all right? That's one thing I implore you to do. If it's in your head, you'll have a tendency to stretch your losses and cover your profits a little too early. But 30% of max profit, that's for the lower risk tolerant guys. 50% of max profit would be for people with a higher risk tolerance, okay? So know your exits, write those things down so that you stay mechanical with it, all right? If it's not looking too great, you can always roll it at expiration and collect a credit. One thing is, with the iron butterfly, because we're selling those at the monies, you're never gonna get all 100% of this credit, you guys, all right? So that's why, and it's gonna take a long time to decay. All right. So another thing you could look at for your exit on a winning trade, less than 10 days to expiration, or less than 10 days in the trade, and you get 10% of your max profit. That's a pretty good trade. 70 cents out of this in less than 10 days is a pretty good winner. And you can write those down for that type of thing. You know, if you have to be less than 30 days or if you're in this for 30 days and you have 40% in max profit, I would pull that ripcord immediately. I'm out. All right. So, you know, you can think about that. I was looking at like an $8 credit. Let's call it an $8 credit on my strategy. If I can get 10% of that, 80 cents in less than 10 days, that's a pretty good winner, especially on this type of thing where we're looking at this thing to like stay tight for how many days? It's a long time to be staying in a tight range, but you got a huge credit for this. All right. So if we can just kind of be like that thief and like take our singles, doubles, and triples using this strategy, you know, we're willing to take a little bit less of a full profit. I know some people out there are like, take it all the way into the last day. That's not me, man. I see these singles, doubles, and triples, and I'm out of them, right? I have a high win rate, right? Because I'm getting in and out of these rather quickly. I'm a winner or a loss. And I talk about that in the daily market commentaries. You guys can watch me on a daily basis do my trades. I don't cherry pick, all right? I don't say, well, if you would have done this strategy, you would have been up 500% and never talk about my losers. If this strategy goes against me, the iron butterfly goes against me, you guys are going to hear me talking about that thing almost every single day in the daily market commentary because I'm doing different things to stay mechanical with it, all right? So you can check those out as well. All right. Any other questions? Tried to answer a couple as they were coming in. All right, you guys. I'm going to throw this over there in the chat window for you guys to take a look at. There's a link right here that if you're watching it on tape delay, you guys can punch this into your URL or hit it over there in the chat window. This is pages of content that you guys will get. You guys get full access to everything, including me, all right? That means you guys can reach out to me with any of your questions at any time, and I will answer you. I have a no inbox policy, meaning as soon as you guys reach out to me, I'm going to answer you as soon as humanly possible. The reason why? Why? Because I know what it's like when you're twisting in the wind and you're worried about this trade and you want somebody to give you a little bit of guidance. Well, you get access to me with this offer here. So make sure you take advantage of it. Also, first 100 members will get, it's less than 100 members. They told me to change that, but because it's already starting to fill up. You guys get the Option Lab program. You guys get automatic upgrades to other content, which means you get access to the future content, promotions, discounts, all of that stuff with this. And you get all of my webinars. So when I talked about watch this strategy or watch this webinar again, well, you can go to one of those other ones, maybe one of the shorter videos where I'm and kind of going over the broader concept a little bit more. You can go over those. You have full access to it. It also gives you a nice little check mark. You can check off the ones that you've watched and the ones that you haven't stay open. All right. And like I said, this is your questions and answers. If I can't answer you guys in an email and I don't like to type, then I'll reach out to you. I'll be like, hey, let's hop on a Skype call. We'll screen share, do all of that stuff and a bunch more. If you hit that link over there in the chat window right now, it will pull up the actual web page. You will see why I didn't put all of that on here. I just don't possibly have the space. So you get that for $97 a month. But actually, I forgot to write that down. If you pay for a full year, it's like it's less than $500. All right. So if you do it for a year, it's less than $500. Forgot to slide that in there for you. So make sure you take advantage of that if you want. It's basically half price if you take advantage of this today. So $97 per month, or the real deal is to get it for half price, and I think it's less than $500 right now. All right. So again, I want to thank you guys all for participating in this webinar. Later webinars, I'll drill down on different option components, when and where I find them. Also, if you're watching on tape delay, you're going to have to punch that in, pause it. If you have any questions, comments, reach out to us 310-598-6677 or trading@protraderstrategies.com. Also, please take a moment to go over the disclaimer. Yes, there are risks to investing in options or any other thing, and you guys need to know what your risks are before entering this. And I'm not trying to get you guys living off the cliff with me. I'm just trying to give you guys examples of how we go about implementing option strategies. It's up to you guys to be big boys and girls and figure out if it's a cut according to your risk tolerance. All right, so check this out. Click on the link. Also, best thing you guys can do for me is, if you like this webinar, give me a thumbs up for one. But the best thing is hey, introduce me to one of your friends. Throw them out and say, hey, we got a Wolfman Pack webinar. Let's go watch this together. You know, it's great to have somebody else to bounce ideas off of with trading, you guys. I can't emphasize that enough. As a trader of 25 years, I still reach out to some of people that I've traded with in the past and talk about options and trading and stuff like that. So always great. If you know somebody out there that likes to trade or invest, you know, let them know about this. Because if they're watching TV and watching these guys on Twitter that think that they know everything about options, I can tell you, they're going to be getting involved in pen weeklies, buying calls, all right, based on somebody saying you need to go out and buy the 75 calls or something crazy like that. You know, why would you want all that theta decay? And get in the weeklies where Penn doesn't have a lot of participation. All right. Thank you, Scott, for the kind words. Appreciate it. Thank you, Alexander. Also, that's all I got for you guys. Check us out on Facebook at protraderstrategies.com. We throw a lot of content out there, and you guys can also follow me on Twitter at Wolfman's blog. All right. That's all I got. Other than one last thing for you guys that have the cameras up. If you can't take that, take it easy. Yes, I'm deadly with that thing. Bye for now.